Welcome to the foundation of modern low-stress investing. The core philosophy behind a 3 ETF portfolio is straightforward. You can own essentially the entire global financial market using just 3 funds. Pioneered by John Bogle and the Bogleheads community, this strategy is designed to eliminate single stock risk, protect you from expensive fund manager errors, and keep your overall investment costs extraordinarily low. Instead of trying to find the needle in the haystack, you simply buy the entire haystack. By funneling your investments into just 3 core building blocks, you gain instant exposure to over 10,000 worldwide securities. Historically, this broad market exposure has delivered a solid 6.9% real inflation-adjusted return, giving you maximum global reach with minimal effort. To understand how this portfolio functions, let's break down its 3 structural pillars. First, we have total US, stocks represented by funds like VTI or ITOT, which gives you ownership in domestic corporate giants and innovators. Second, we add international equities through funds like VXUS or IXUS to capture foreign markets. Finally, we include total US, bonds such as BND or AGG, to provide income, capital preservation, and portfolio stability. What makes this structure incredibly efficient is its purity. There is exactly 0% internal overlap among these 3 components. Every single dollar you invest goes into a distinct asset class, ensuring your portfolio remains completely streamlined without redundant holdings. Let's take a closer look at our primary growth engine, US equities. This component acts as the main driver of long-term capital appreciation in your portfolio. Through a single fund, you gain market cap-weighted access to roughly 3,700 companies, spanning large-cap tech titans, mid-cap dynamic firms, and small-cap growth opportunities. Because it is market cap-weighted, the portfolio automatically adjusts over time, riding the momentum of economic winners while trimming exposure to declining businesses. Best of all, you get all of this broad, self-cleansing growth exposure at an ultra-low expense ratio of just 0.03%, allowing virtually all of your capital to compound uninterrupted. While the US market is powerful, relying on a single country leaves you vulnerable. That is where international equities step in as a critical hedge against potential domestic downturns and a weakening US dollar. This single international leg gives you instant access to more than 8,000 companies outside the United States. The global market distribution within this fund is split roughly into 75% developed markets, such as established powerhouses in Western Europe and Japan, and 25% emerging markets, including high-growth economies like India and China. This allows you to effortlessly capture world-class global market leaders and international economic expansion without having to research individual foreign exchanges. Every strong portfolio needs a shock absorber to cushion the ride during turbulent economic storms. That role belongs to fixed income, which focuses on psychological resilience and capital preservation. Holding over 10,000 investment-grade US bonds at an ultra-low 0.03% expense ratio, this asset class brings structural, steady yield to your wealth strategy. When stock markets experience severe downturns, this bond cushion softens the impact on your total portfolio value. More importantly, it provides the psychological safety net you need to prevent panic selling at market bottoms, ensuring you stay the course when markets are at their most volatile. Now that we know the 3 components, how should you divide your money among them? The answer depends entirely on your age and risk tolerance. Investors in their 20s and 30s can adopt an aggressive allocation, for example, 60% US stocks, 30% international stocks, and just 10% bonds to maximize long-term growth potential. As you move into your 40s and 50s, a moderate allocation like 40% US stocks, 20% international, and 40% bonds helps lock in gains while reducing swings. In your 60s and beyond, a conservative mix with 60% bonds, prioritizes income and capital preservation. A classic rule of thumb is setting your bond percentage equal to your age, or your age minus 10. This simple framework automatically shifts your portfolio from growth to defense as you get closer to retirement. The true superpower of this 3 ETF portfolio comes down to basic math. Microscopic management costs combined with extreme tax efficiency. With a blended annual cost of roughly 0.04% to 0.05%, you retain almost every penny your money earns. To put this into perspective, let's look at a $500,000 portfolio. With our 3 ETF strategy charging around 0.05%, your total management fee is just $250 per year. An actively managed fund charging 1%, on the other hand, creates a $5,000 annual leak out of your portfolio over a 30-year investing journey. Plugging that leak saves you 6 figures in lost compounding power money that stays directly in your pocket. Finally, executing this strategy requires surprisingly little work. The ideal maintenance approach is one of benign neglect, requiring less than 30 minutes of your time per year. Over time, market movements will cause your asset allocation to skew away from your original targets. Rebalancing simply means trimming your overperforming assets and buying more of your underperforming assets to restore your intended percentages. This mechanism creates a disciplined, emotion-free habit of buying low and selling high. You only need to trigger a rebalance under 2 circumstances, either once a year on a set date like every January, or whenever any single asset class drifts off target by more than 5%. Set your target, rebalance on schedule, and let compounding do the rest.